I was a wealth advisor at PNC and Key Private Bank. In my final years as a wealth advisor, every new client I brought in had just sold a business. Do you remember in 2006, some of you may not be old enough, but I'll give away my age here, but do you remember in 2006 when the book, The $10 Trillion Opportunity, was released? The author's big premise was that boomers were going to sell their businesses. There was going to be a tremendous amount of wealth transfer over the next couple of decades. They were right. In my experience, we have definitely seen that. About halfway through 2018, we started a new business line at Wren, Complex Assets. Honestly, it was a bit audacious because the previous year, we'd only done 4 complex asset gifts. However, we saw a trend. More and more advisors were asking how their clients could give their private business interests or other illiquid assets, such as hedge funds or private equity holdings, holdings with big gains. They wanted to offset their taxes with a charitable gift to a DAF. So we started the complex asset business at Wren with in-house expertise. Last year was a major year for all DAF providers. I'm telling you, we were exhausted. Anyone who worked in the complex asset space was definitely feeling it. With the proposed tax increases on capital gains, many business owners took that opportunity and sold. In fact, all but 2 of our complex asset gifts last year was some sort of business interest. But not only do the clients benefit, the advisor and the firms benefit as well. These illiquid assets are turned into investable assets that are net new assets to the firm. In just 3 short years, we completed over $1 billion in complex asset gifts. We've worked on, in addition to business interest gifts, we've worked on numerous IPOs, SPAC mergers, tech unicorns, podcasts, lots of private equity and hedge funds, alternative investments, and the good old operating businesses, lots and lots of those. Most of these gifts are given prior to selling or going public. Once they're sold, there's cash to invest and then to grant to charity. So today I plan to discuss the types of complex assets and some of the considerations for these, as well as a high-level look at the process. I plan to focus my attention on business interest gifts, including alternatives. Is there anything else that you'd like me to cover today? I'll leave plenty of time at the end for Q&A, I promise. Anybody? Unmute your mic real quick if there's anything else you want to cover. All right, sounds like that's what we want to talk about. According to a study by Bank of America and the Lilly Family School of Philanthropy, nearly 90% of affluent households give to charity. And this is a number that's been fairly consistent over the years. They've also found that the amount of giving has increased by nearly 50% just since the previous study 2 years previously. The trend for using charitable vehicles, including DAFs, has also continued to increase. You may recall that earlier this year, do you guys remember hearing that billionaire Elon Musk gave a whopping $5.7 billion to charity? And that, my friends, was given to a DAF, a donor advised fund. The ultra wealthy are seeing the benefits of utilizing a DAF. And nearly all ultra high net worth individuals have non-cash assets that may be suitable for a contribution to a DAF. And while the tax benefits are important, it's not the only reason donors give to a charity. But if they're going to give to charity anyway, let's help them give in the most cost-effective and tax-efficient way. So let's talk about different types of complex assets, starting with personal assets. These are the sexy ones, right? These are the ones everybody wants to talk about. And a lot of times they don't necessarily make sense for the donor, with the exception of real estate, as you see on here. You'll find with gifts of real estates, DAF sponsors are going to want that real estate in some sort of liability wrapper, like an LLC. From a risk perspective, they're going to want to separate that from other assets in the charity. So if the real estate is held in the donor's name directly, or if it's in an IRREV trust, what we'll do at Wren is we'll partner with an outside firm to handle those gifts. Now, with real estate, there are several things that you have to think about. Like debt and charity don't go well together. You have to look at the depreciation. If it's a property that's been depreciated, you're going to have to look at what its use is. Do they have renters? There are lots of considerations with real estate. It is an incredibly complex gift, so it can be expensive to give. If real estate is commercial property and it's held in a partnership or a REIT, that's a whole different story. And we would look at that under a business interest gift, which we'll discuss in a moment. Art and collectibles. So when you think about that, you're thinking about paintings, sculptures, gold coins and bullion. I get a fair number of requests about that, and rare books. Unfortunately, the charitable deduction is the lesser of cost basis or fair market value. So typically it's not a huge gain for the donor to make that gift prior to a sale. This is what I was talking about, where it may not make sense. So each case is fact specific. So it's important to give me a call and let's talk about it. Where I've seen this work really well is in the case of a rare book collection. This is one of the two that were not business interest gifts last year. The father had passed away and he left the books to the kids. So they received that step up in basis. The estate received a $1.7 million charitable deduction, and then the DAF received the proceeds from the sale. So that worked out really well. Let's move on to the financial assets. As I said before, 98% of our gifts have been some sort of a business interest. M&A type gifts are very common. The private company stock can be C Corp, LLCs. LLCs taxed as, and I'm going to ask you this question, LLCs taxed as an S corporation or taxed as a partnership, limited partnerships, and some S corps. So let's spend a minute on S corps. S corps are something of an outlier. The charity is going to pay taxes, what we call unrelated business income tax, or UBIT. So you may hear UBIT thrown around, that term thrown around quite a bit. So the charity is going to pay taxes on the gain and any income that's attributed to the DAF during its ownership. It's generally the only business type where the charity has to pay tax on the gain. So it's an incredibly complex gift, so keep that in mind. There's a lot to consider with an S corp. Restricted stock. So when I'm thinking of restricted stock, I'm really thinking of like the stock that has some sort of restriction. You've got the 144s. Generally, that's going to be cleaned before it comes to the DAF. But if in this context, when I'm saying restricted stock, I'm thinking that there's some restriction for the charity to not be able to sell it outside of 144. So like last year was a super hot market for IPOs and SPAC mergers. With the new regulation, gosh, that has chilled significantly. I'm sure you've all seen that as well. I don't think it's dead. I think they're just working through that. I think we're going to see an uptick again next year or even in 2024. But for those few that are going through the process, if you have clients who are going through that, what we found is that after a stock has gone public, there's a lockup period where the pre-IPO shareholders and insiders are not allowed to sell their stock. And they might be limited to sell a certain percentage, but generally, there'll be that period of time. The most common lockup period I see is 180 days, but it can vary. But I mean, if you think about it, for many of them, they've acquired some serious life-changing wealth through this process. And now they're stuck with a huge tax bill for that year. So for many, the lockup period won't end before year end. So, and we really start to see these gifts come in more after July. So if it's not going to end by year end, the DAF sponsor has to be willing to sign that lockup agreement. And we will. The fact that we're not asking for anything that's not granted to any other shareholder, that sets us apart, and we've been successful in getting council on board to allow the transfer. So that's what I mean by restricted stock. Partnership interests in hedge funds. Let's talk about those two together. Often these are alternative investments or private equity with a long-term hold. So what we're going to think about with those, we're going to look at, we're going to want to know, are there any outstanding commitments? How much time is left for the fund? 10 plus 2 is pretty normal. And usually when somebody's making that gift, we're seeing a little more mature holdings. And I think it's also important to note that they don't have to give up their entire holding. I had quite a few people think that they had to give up all of it. No, it can be a percentage of that. These kinds of gifts will typically require general partner approval. In fact, I've never seen one that doesn't require GP approval. Let's talk about private equity for a second. And I've had several people call and ask for this particular situation. So, with a private equity, they may have 4, 6, 8, 10, maybe more underlying investments. So let's say they've got one of the companies, maybe they've sold off some, they're down to a handful of companies, and one of them's getting ready to liquidate. And I've had calls where people want to give a portion of that company. Unfortunately, you can't do that. You can't carve out a specific company. You have to give for the whole of the thing. Think of it like a tree. You can't just give a branch of the tree. You have to give a portion of the entire tree. So just keep that in mind if you're looking at private equity gifts. Another thing we run into, carried interest. Yes, believe it or not, that can be donated. We don't want general partner shares. We don't want that unlimited liability. Sometimes we'll see, I'll get limited partnership shares of the GP, but what we don't want is that unlimited liability. So carried interest is not an unusual gift. We don't get them every day, but we do get them. A lot of times with alternatives, maybe they're held in another DAF provider. Yes, you can transfer for those from other DAF providers. The donor would just submit a recommendation for an in-kind grant, and then they can transfer those over. I would recommend, that you get with us. We see if it's one we've already looked at, if it's approved. If not, let us go through that due diligence process and then go back to the DAF sponsor and ask if they would be willing to transfer that position in kind. So we do some of that. If you want to make an investment in an alternative, we do have, that is available in our DAF program. We do ask that the account be at least $1 million and that the investment be at least $250,000 and that there be at least 20% liquid securities or marketable securities, I should say, in the account. So I think that's pretty generous. And keep in mind, it's a pretty big ask to do anything below $250,000, which is, you've seen the subscription agreements, right? So we do ask that they be at least $250,000 million minimum account. And then let's talk about stock options and other equity compensation awards for a minute. Most of these awards will not work in their current form as they result in taxation to the donor on exercise. Regardless of who owns them, once that, if they give those options, then the donor still has to pay. So there's no point in making a gift of the option. Most companies won't even allow it because of that scenario. So where those work the best is, once they've been vested and held for more than a year, then we look at those shares that they acquired upon vesting. Those are ideal assets to gift. And I've seen huge spreadsheets of, when people have all these different options investing, and you want to look at the oldest or the ones with the largest gain that they've held for at least more than a year, and just see what makes sense for them. Let's talk, let's do a case study, and then we'll go over the process. So last year we had one of our clients was selling their tech business. They had zero basis, of course, which is the typical scenario. The business was structured as an LLC, and it was taxed as a partnership. As I mentioned before, when we talk, this is one of the first things I'm going to ask you is, how is the business taxed? It matters. In fact, I got to tell you, I get downright giddy with C Corp says, because the DAF doesn't pay any taxes on the gain or income. So with every other business, the business type, the DAF pays taxes on any income that's attributed to it during its ownership. But back to our story. The donor was really passionate about giving to charity. So he and his wife give regularly, and in fact, they already had a DAF. So I love this story. The donor told me a story about when he set up the DAF. He wanted to get his grandkids involved. So he asked each of them, and I think he said there were 8 grandkids ranging in age from 7 to 17. He asked them to prepare presentations and make a pitch to the group about the charity of their choice and why grandpa should give to them. He said it was an amazing experience. The kids did a great job. They came really well prepared. And he said, I learned so much about my grandkids in that process. And I learned what was important to them. And it was just such a powerful story. He said, I ended up hitting the table and saying, well, we're going to give to all of the charities. And this has become an annual tradition for them. So, when it came time to sell his business, he reached out to his advisor and they discussed making a gift. He ended up giving 10% of his holding prior to the sale. Let's talk about this. I'm often asked, what's the ideal time to give? 2 weeks, 2 days, 2 months? I'm going to give you an attorney's answer. And for all of you attorneys out there, you're going to know this answer. It depends. First of all, let's just say it's not something I want to give an official opinion on, and you don't want to either. I always encourage working with the tax advisor on the timing of the gift. I do not want to make a recommendation on that. I will say that there needs to be some element of risk that the deal can still fall through. If the IRS determines that this was all but certain to occur, they may consider this to be an assignment of income, and they'll treat that gift as a gift of cash, meaning the donor would not avoid capital gains. They still get their deduction, they just don't avoid the capital gains. So I've got a couple of examples. So we had some donors that were making a gift. They made the gift on Friday. The business sold on Monday. I said, to the attorney and the CPA, I said, how is this not an assignment of income? And they said, Kim, we negotiated all weekend. This deal was definitely, there was still risk that this deal could fall through. Okay. And they're the ones who have to argue with the IRS, right? So versus another gift that I worked on last year, where the guy called, he and his attorney called and said, hey, we're getting ready to sell. We're pretty well there. The only thing we're waiting on, the buyer's trying to get financing from the bank. And he said closing is scheduled for 28 days from now. And I said, well, where's the bank? He goes, well, we could hear at any time. So we had to scramble to get the gift completed. And I think we got it done with 25 days left before closing, but we had to scramble to get it done before that bank had approved the loan, because once that happened, then it was all but certain to occur. They were just waiting for the date. So the date doesn't matter as much as how much risk is still left in the deal. So that's a really popular question. It's a great question, and one that, again, case specific. But in the case of our donor here, he provided us with due diligence documentation, and we presented that to the board for approval. We didn't present the documentation. We take that, we gather that information, do our due diligence, summarize it, and then present it to the board for approval. And this process took about 7 days. We prepared then a gift agreement, and the donor assigned the interest to RCF. And we haven't talked about RCF. RCF is Renaissance Charitable Foundation. That's the name of the charity that sponsors the Donor Advice Fund. So the business sold a short time later, and then the proceeds were wired to RCF and then were invested shortly thereafter. Before filing their taxes the next year, the donor obtained a qualified appraisal. And that qualified appraisal is what is used to substantiate their charitable deduction. This is not the same thing as a business valuation. And business valuations are fantastic. And this is not our requirement. This is not an IRS. This is not an RCF requirement. This is an IRS requirement. And the IRS has very specific rules about what needs to be in the appraisal and who can do them. And this applies to all complex asset gifts, including alternatives. They're not cheap. So it's important to factor this into the overall picture as you're considering complex assets. The size of, I guess I should say the size of the gift. So let's take a look at the math on this one. In this case, with discounts and everything, the appraised value ended up right around 9 million. When I say discounts, the qualified appraisal will most likely have some sort of discount. Often it's lack of control. If you get the appraisal done after the business sells, after the gift, it doesn't have to be done before the gift is made. They have until the time that they file their taxes the following year. So there's no need to scramble for that. In fact, I typically recommend people do it afterwards. So hopefully you shouldn't have the lack of marketability discount, or it should be lessened. I think I heard from an appraiser yesterday that they're looking in the single digits with discounts. I'm not an appraiser, so I don't have the mind of the appraiser, so I can't recommend or give you a real good idea. I'm just telling you what I heard from an appraiser yesterday. But in this case, we have the charitable deduction was 9 million. He avoided capital gains, that 20%, 1.8 million. In this one, he avoided the net investment income tax of 3.8%, so 342,000. Now, this is one that a lot of people forget about, is the state income taxes. And in his case, it was a 7% state tax rate, which is ends up being the average. But that's a significant number. When you look at that 630,000, if you're in the state of California, and we've done a lot of gifts in California, gosh, at 13% state income tax, that matters. That's a big savings. So you look in this gift, almost a third, almost 30% was of his total gift was saved in taxes. So almost $2.8 million of total tax savings. So that's this is compelling. This is what I'm saying. This isn't in and of itself is not enough to say this is what I need to give to charity. If they're charitably inclined, this is what I mean by helping them with a cost-effective, tax-efficient way to do it. This is powerful. So let's talk about the process itself. And I'm going to keep this fairly high level. What we're going to do is you're going to call me. First step is call me. Let's talk about it. Call me or shoot me a text or shoot me an email, and we'll schedule a time and we'll go through. I'll send you the doc. I've got a document that outlines the process and the white paper on qualified appraisal. So you'll get that information immediately, and then it'll go through these steps in great detail. But the first thing we're going to do is talk about what the gift is, and you're going to assemble the due diligence documents from the donor. Could be the donor and or their professional advisors. You're going to look for things like governing documents, any shareholder agreements, most recent tax returns and financials. Don't worry about NDAs. We're used to that. We sign a lot of NDAs. That's pretty standard in the process. So once we gather those due diligence documents, we'll get that reviewed. Come back with any questions. If there's anything, like for instance, if there's occasionally we'll see capital call provisions in there that say, hey, if we ever need money, we can hit you up for it. We're going to ask that have the charity waived from that, just as an example. But rights of first refusal, we're going to want to be treated like any other shareholder. So we aren't going to come back with unreasonable requests on that. So once that's approved, then we complete the gift agreement. We'll prepare the gift agreement, and the donor simultaneously will be working on the transfer. Let's talk about the gift agreement for just a second before I go on. So our gift agreement is about 2.5 pages. We do not have a put option in our gift agreement. And that's kind of a big deal. So if you're not familiar with the put option says, hey, if we haven't sold this business within a year, or this gift within a year, we have the right to come back and require that the donor repurchase those shares at then fair market value. We don't have that in our gift agreement, so keep that in mind. The other thing in our gift agreement that I will say, we don't charge any upfront due diligence fees. We look at our work as on the front end as an investment in a long-term relationship. So what we're going to ask is that we want the donor, absolutely want the donor using the donor advice fund. Please do not misunderstand me. But what we don't want is we don't want to clean the asset for it to go right back out to a charity. That's not what a DAF is designed for. And there are companies out there that do a great job with that type of gift. So our gift agreement will say, though, if you're just using this to clean it, we're going to charge you a fee on the way out. And think of it like a B share. We're gonna have an extra fee at the end. But I can't think of a time that someone has done that, because I think we're pretty clear about that up front. And so we've not, to date, had to charge for that. The transfer process, that is driven by the company. Each company has its own transfer process, and we just follow along with that. So once that's done, the gift agreement is signed by the donor and by the charity, being the DAF. And then the transfer documents are typically, the company will have that process, and it's usually the donor is signing it. There's often someone approving it at the company, and then the charity will sign accepting the shares. All of this you work through me. I've got a great team, but I'm your person that gets it to where it needs to be. On this slide too, I see it says additional review is not required once a complex asset has been approved. Let's talk about what I mean by that. So especially in the case of, if you've got multiple donors of a company I've already done, I can think of one last year where there was one company, we had 3 different donors, and they all worked with different advisors. Well, we had already done the due diligence once, so that just covered everybody. So then it was easier for the other 2 advisors who came in later. The same goes with alternative investments. If we've already looked at that and approved it, the one that it comes to mind, because I've worked on 2 of them this week, is BREIT. Like that's, we've already done the due diligence on that. If you have clients that want to give BREIT, go ahead. That's an approved. I think there's an Apollo. I don't want to start trying to remember all of these, but we've done a few. Keep in mind, we're still fairly new with UBS, so we're working on that list of getting several approved. So within the next year, I think we'll have a lot of them on our platform, or when I say on our platform, approved to be used. So once a gift agreement transfer is completed, the gift is approved and you're done. So now what happens? So after the donation, If it's applicable, again, not if it's about long-term hold, this doesn't apply. But if they're selling the business or that we're going, or it's artwork or something else, that we're going to liquidate that asset right away. And then those proceeds come in and the advisor invests those into traditional assets or alternative investments. The donor then gets to go ahead and recommend the grants to the supports to the causes that they care about. And don't forget that qualified appraisal. It has to be done by the time they file their taxes next year. And there's a form 8283 that is going to be signed by the donor, the appraiser, and the charity. We are doing tons, we are signing tons of these right now. The 8283s, as everybody's getting ready to file their taxes later this week, I believe. So that's the post-donation process. So why use RCF? So we've had advisors tell us that the reason that they've enjoyed working with us is our responsiveness. We've gotten right back to them. We have been able to turn, when we've had some people who've had situations where we had to act really, really quickly, and we were able to do that. We were pretty nimble. The fact that we do not have the upfront due diligence fees has been meaningful for a lot of people, and that we're willing to hold those assets for more than a year. That one-time approval that I mentioned before, once we've approved it, you don't have to go through it over and over again for each of your clients. Our flexibility with the investments and the alternatives and being creative in how we can get things done. Advisors have really appreciated that as well. And then true discretionary investment management. What we want you to do is invest the funds as you would for your other clients. We want to be treated the same way. So you don't have to prepare a memo for each time you want to make a shift. This has been really meaningful this past year as things have happened pretty quickly in the market, and advisors want to be able to take advantage or to make shifts pretty quickly. If you have a discretionary investment management account, make those changes as you're doing for all of your other clients. I guess that's what we would ask. So we've talked about a lot of different types of complex assets today. We've looked at the case study and we've looked at the process from a high level. So now I'm going to open it up. I told you I'd give you lots of time for questions and answers. What questions can I answer for you?
Kim?
Yes.
We had our first question with what's the average value of a complex asset gift?
Our average size has been 6.7 million.
Great. I think any other questions should come through the chat, so I'll monitor that.
Or feel free to take yourself off mute. I don't know if you've got everybody muted, but. Is anybody working on a complex asset they want to, or have a client who's considering one that you want to chat about real quick?
No.
All right. Well, I will give you back a couple. Okay.
Oh.
Compared to Fidelity, what are the advantages of using RCF? Great question. And what we have heard is so they don't have due diligence fees. The fact that we don't have a that put option has been a big differentiator. The fact that you can invest the funds on your own platform, they've liked that a lot. And that we're not going to push you to use certain things so that you have discretion. Again, we're agnostic as to how you want to approach that. I think our fees are comparable. Kelly, anything else that you can think of? Or Jeff? Good, thank you. I'm going to give you my email address. It is ledgerk, and it's, ledger is in accounting, LEDGERK at Ren Inc. REN as in Nancy INC.com. Yep, and it's in the chat. Reach out to me. I'm happy to get those process documents out to you if you have situations you want to discuss. More than happy to get on a calendar. My days usually book up a day or two in advance, so I'm, I try to be as available as I possibly can. And I know a lot of you on the West Coast, so I'll work with you on that too, from a timing perspective. One more thing that I'll mention too that people ask is if I'm available to meet with donors and their other professional advisors, and the answer is absolutely. That's a big part of what I do, is working with the advisors from their financial advisor, the attorneys, CPAs. It's not unusual for me to be on the call with a general counsel and a CFO. So I'm more than happy to assist with that. All right, with that, I will let you all go and look forward to meeting you. Thank you so much for attending today, and we look very forward to working with you. Have a great day.